Hi, everyone. Jim Kruzan here, and welcome to our February market and economic update. This will be short because there really hasn't been a whole lot that has changed since last month, but I still want to keep you kind of in the loop as to what's going on. As always, our opinion is one of two things will happen here. We're either going to see a recession or we're going to have a soft landing. There's not a lot of data as of yet that's suggesting a rebound, but we were also expecting a bit of a broadening out. Performance should be driven by something other than just Mag 7. And you'll see in a minute, we're beginning to see that. Our friend, the LEI, the leading economic index, continues to drop. For the month of December, which was reported out mid-February, it dropped 0.2% and continues to drop as it has been for better part of now 2.5 to 3 years. The economic data is again mixed. We saw a drop in the LEI, as I said. Consumer credit card use and delinquency and default rates continue to rise. In fact, the delinquency rate right now on credit cards are a whopping 12.7%. That was released mid-February. And that's up well over a full percent from just a year before. When you think about office buildings and vacancy rates, that's having an effect as well on mortgage-backed securities. As reported in February, we now have a delinquency rate at an all-time high of 12.3%, and that's up from 10.2 just a year ago. These are not the kind of data points you'd expect if the scenario is a recurring, resurging economy. Other economic news continues to be mixed. For the first time in a while, we're seeing a general uptick in manufacturing activity. Some of that might be beginning of the year. Some of that is certainly the one big beautiful bill. But in most areas, New York, Philadelphia, Chicago, we're seeing a bit of an improvement. We haven't seen that in a long time. We'll be watching that data closely. As far as other items, inflation, still a bit sticky. The PPI, which is referred to as kind of the wholesale number, that jumped almost a full percent last month, 0.8%. And now that number has accelerated to 3.6% a year. That now marks a 10-month high, indicating persistent inflation pressure. That may affect the scenario, which is interest rates will continue to drop. As far as employment, again, a mixed bag. One thing that we are beginning to see, though, is a real trend in job openings. These continue to fall. And in fact, the number of new job openings fell almost 400,000 in December, which was reported out this past month. That is now the lowest that we've seen since 2020. And by the way, 2020 was beginning of that whole COVID thing that first year. So as a result, these are really employers are getting very stingy in terms of who they hire and positions they're hiring for. As far as the markets are concerned, we're still seeing incredible valuations relative to certain metrics. The Buffett indicator, which we've spoken about, remains at 230%, or it was as of the end of the most recent quarter, which was December 31st. If we consider it today, based on the drop that we've had in the market the last couple of days, that number is now about 216. And the Shiller index, which hugs around 40, which is a near all-time high, continues to hug around 40 at 30.9. As far as the performance for the month, it's a mixed bag. In the month of February, the S&P was actually down 1.4%. The NASDAQ, consider that tech latent, consider Mag 7, was down nearly 4%. However, we're seeing a broadening out. Value stocks were up nearly 3. International securities were up nearly 4. emerging markets were up over 5. And we also got a lift in bonds, at least in the month of February, as long-term 20-year bonds were up nearly 5%. Gold was up a whopping 13% in the month of February and well over 21% for the year. The S&P, sadly, was up just 0.3% for the full year, whereas value stocks were up 7+%. So we're beginning to see a change in leadership. And this is something that we've been expecting for quite some time. If we look at the performance of the Mag 7, for the first time in a very long time, it did not contribute at all, or I should say, to the downside, it contributed quite a bit. First and foremost, it's still a very concentrated position. The Mag 7 through the end of February represented 32% of the index. To put that in perspective, during the dot-com bubble, the largest 10 stocks represented just 20% of the index. Today, the largest 10 stocks represent just under 40%. In the month of February, the Mag 7 contributed 1.8% loss to the S&P, and the S&P for the month was actually down 1.4. So in a convoluted way, the Mag 7 contributed 130% of the downdraft that we saw. For the year, while the S&P was up 0.3%, as we suggested earlier, the Mag 7 was down nearly 2. We're beginning to see some rotation out. Remember, typically the bigger they are, the harder they fall, and this should contribute to some additional volatility in the months ahead. Well, that said, that's kind of it for the month of February. We're watching things very closely. If there's a need to communicate before the end of the month, we certainly will. And as always, if you have any questions, please reach out. We'd love to hear from you. Take care. We'll talk to you again next month. Thank you.